All right. Well, welcome to Module 6. Just like to recap where we've been so far in the first 5 modules. This Module 6 is going to be the kind of the end of the construction development cycle. So kind of a nice midpoint in our 11-week walk through the chronological life of a typical tax credit project and accounting issues. So up until now, we've been focusing on, at the beginning, it was all about accounting for pre-development funding, and then we talked about legal structures, how to set up, whether to choose nonprofit versus partnership versus LLC. We talked about the low-income housing tax credit program in particular in Module 3, and how those deals are typically structured, how the credits are awarded. And then in Module 4, we talked about investor relation issues, projections, letters of intent, choosing which investor to go with as your partner for the next 15 years on these deals. And in Module 5, we actually got into construction issues and accounting for different types of development costs, as well as the loan draw request forms called requisition forms. So now we've kind of walked through the whole process all the way up through construction. And we're going to talk today about what happens at the end of construction, after construction is completed. So that will include the cost certification form, which is an audit that CPAs like myself do. Gail will cover some best practices in preparing for your cost certification audit. And then we'll also cover 8609's, which are the IRS tax form that communicates how many tax credits were awarded building by building. And those forms get attached to your partnership return every year when you file with the IRS to show the amount of credits that you're entitled to for that year. So that's where we're headed today. Before we get into the meat of the presentation, though, as usual, we'd like to meet a few more of our classmates. So Sophie's going to separate us into different rooms, and we can spend about a minute introducing ourselves to each other with our name, where we work, and what is our role in our organization. So Sophie, please send us to our rooms.
For people just now joining us, we are currently in our breakout rooms introducing ourselves. So if you see an invitation for a breakout room, go ahead and join that room.
Okay, I think we're all back in our main room. Got to meet a few more people this time. Once again, we're doing a kind of a soft warm-up poll just to get used to pressing the button on your keyboard. So Sophie, please launch the first poll. You need to complete these polls in order to get CPE credit for each session. How many times have you lost track of time in the past week? It's kind of split. So at least whichever category you fall into, you're not alone. All right. Let's move on. All right, so we're going to be talking about cost certifications to start with. And we'll show you the format for a cost certification today, but recognize that depending on which state you're in, it may look totally different in your state. Every tax credit awarding agency, and as we mentioned at the beginning of this discussion of tax credits weeks ago, every state has its own tax credit awarding agency, and they each come up with their own regulations, kind of reinventing the wheel for that state. And part of that involves what a cost certification should look like. So what we're going to show you today is a Massachusetts version. It may have no resemblance whatsoever to your state's version of a cost certification, but the important thing is that they all are trying to do the same thing. So hopefully you'll see the value of the one we're going to show you today. But the idea of a cost certification is the development costs, which are all of the costs really incurred up until the permanent loan closes. Someone, namely a CPA firm, needs to audit that schedule to say that yes, these are all of the development costs. The categories are accurate. Building versus land. Things are in the right bucket, and this is the eligible basis amount of those development costs. So not every cost is going to be eligible for tax credits. And so this form is designed to show not only the total cost, but also how much of it is eligible for tax credits. So this is used by the state committee to award the credits. It's used by the investor to see how their capital contribution was spent and what all of the different categories are that are going to be on the tax return for the eligible basis. It's used by the sponsor to really to show what costs were included in the development cycle. And part of the form is really showing that these development sources balance with the development uses, and that really puts a cap on the all of the activity that occurred during development. So that, for example, last week we mentioned operations might be funding some of the development costs. And so the cost cert would be the place to go to prove that that's true. And that way which costs to include in your, most importantly, in your surplus cash calculation as operating costs, which we'll talk about in future weeks once we get into the operations segment. But there has to be a cutoff between when development ends and operation begins, so that which costs are funded by development sources and which costs are operational costs. Lenders also use the cost cert to make sure that their loan proceeds were spent on eligible type costs. Some loan programs are not allowed to pay for certain types of costs. They may be, for example, a state rule that says your state agency's funding cannot pay for land. We have something similar in California. So you have to have a different source that pays for the land. So we're used to seeing in California a matrix approach on the cost cert that shows lines for the different costs categories and columns for the different sources. And looking at this matrix, you can tell which source paid for which cost. Even though dollars are fungible, we have to prove which category funding paid for which cost. But that's unique to California, and that won't be part of the Massachusetts presentation. So anyway, many parties are using this cost cert amount. On the Massachusetts version, the second bullet point here is talking about the tax credit calculation itself. On the California version, we don't show that calculation on the cost cert, we just show the eligible basis. But today we'll be showing you the Massachusetts version, which actually does show the calculation of the credits. We've seen that before, but we'll see it again today. And the third bullet point is talking about interim versus final cost certs. There may be two versions of the cost cert for any particular property because sometimes your permanent lender will require kind of a either called a draft cost cert or an interim cost cert, but it's something that lets them know, what you've spent so far and how everything balances out with the development sources and uses. And but it doesn't include all of the final costs that arise during the permanent loan closing process, the title fees and things like that. So sometimes there'll be an interim cost cert that's done just to get through the permanent loan closing process. And then after that's over and all those final title costs are known, then a final cost certification is done. So it can be done in two steps like that. Both of them are audits. And the truing up of the interim to the final is usually a fairly minor thing where you're just pulling out a few estimates and putting in some actuals and making sure that it still balances the sources and the uses. So if you do have that situation, it's important to make sure that you're focusing ultimately on the final version, not the interim version, because things do have a tendency to slip around during that finalization process. And it's the final one that really should be the controlling one, and that's the one to send to the state agency to get the tax credits awarded. And so your website for your local state agency probably illustrates what the cost cert format in your state should look like. So, your auditors would also be aware of what that is for your state. See if I can advance that slide. All right, here comes another poll. Cost certification's primary purpose is to determine how many tax credits were earned by the project. Is that true or false? That's kind of a tricky question, based on what I said. Different states kind of use it for different purposes, but I think, ultimately it's designed to prove what the eligible basis was, and that's the number that goes into the calculation of tax credits. Whether the tax credit calculation itself appears on the cost cert is a second question, and probably those of you who said no were thinking that the cost cert may not actually display the tax credits at all. It's just going to display the eligible basis. But the primary purpose probably is really driving towards determining how many tax credits that project gets. And that's why the state agency needs to see the cost cert before they can award the credits. And there's a lot of pressure to get those cost certs done and submitted to the state agency in time, because it can take the state agency many, many months to approve these things and finally issue the 8609. Here in California, it can take 6 months or longer. And that creates a problem when usually the timing of these things we find is the construction is completed and rent up is rushed to happen by December 31st. So all the tenants are signing leases and given keys and told to inhabit their units by December 31st. It's kind of a big push at year end to get that done so that credits can be taken during the calendar year that ended on December 31st. So there's a lot of rushing to get all of that accomplished. And so then a cost cert has to happen sometime after that usually. And so unfortunately that's happening like February, March at the worst possible time for an auditor to have to do something besides the usual year-end work. So now they're trying to do a cost cert too. So that's probably going to happen during February, March, April timeframe. And then the problem is if the state agency is going to sit on it for 6 months, that means you may not get your 8609s until October. which is a problem because the partnership returns are due on extension by September 15th. It's the final deadline for filing them. And in the past, the IRS has said if you don't have the 8609s in hand, you shouldn't claim the credits. You can go back and amend in the future when you get the 8609s. Now that's changed as well, and amended tax returns, many of them now don't change the prior year that was previously filed. The amendment changes the current year tax, not the prior year tax. So depending on what kind of partnership you have, that might be your reality. So it's created a timing problem when state agencies are taking that long to approve the credits. So anyway, there are the results. That poll. So Gail is going to talk about some of the best practices now in preparing for the cost certification.
Yep. So hi guys. I first want to go back a little bit on what Scott was saying. First of all, I just want to let you know, when I first started in this industry, people threw around acronyms like 8609 and I had no idea what that was. So that's just the IRS form. It's form 8609. It's the IRS form that is completed by the developer or the development consultant, and then the state credit agency signs off on it. And that is what is sent to the IRS to let them know that in fact credits have been awarded and how much has been awarded and what the state agency has approved. So it's just a tax form, and you'll see it at the end of the class today. You'll see what that looks like, but it's just a tax form. So the second thing I just wanted to mention is Scott was saying that generally speaking, cash is fungible, meaning you can use whatever dollar of cash comes in to pay whatever costs, even though you allocate it out after the fact. That is not true for bond proceeds. Bond proceeds, if you're doing a 4% deal and you have tax exempt bond proceeds, they are very specific as to what they can be used for. And it's very important that you talk to bond counsel before you even think about spending $1 of bond funds. Generally speaking, bond funds can only be used for hard construction costs. So things like legal costs are not eligible for funds to be used. So you really need to know that up front. So the best advice I could give you is to sit down and talk through all of your sources with your development folks and with legal counsel to make sure you know what dollars can be spent on what. And I have seen bond counsel literally say every dollar is traceable. It's not even enough to say that at the end of the deal, I spent X amount of the bond funds on these eligible costs. They actually want you to specifically trace. So, which is very painful, and hopefully you don't get bond counsel that is at that level. But the important takeaway here is you've got to get in early before you're spending any money, understand what cash is fungible and what is not, and what it can be used for. As Scott mentioned, in California, certain state funds can't be used for land acquisition. Your state probably has something very similar. So you don't want to get caught up if you didn't take the time to figure that out. So please be certain that you do. The last thing I just wanted to mention is this funding requisition. Remember, we're going to use that to prepare the cost certification. Many, many times I have seen cost certifications prepared, and yet there are still invoices that come in, either the vendor's late for whatever reason, that come in after the cost cert is done. And the sad thing is you don't get credits for that because the invoice came in late. But what happens is people forget to track that. And so you really don't know how profitable you were if in fact you're now having to use your development fee or other sources to pay for invoices that are late, that are no longer part of the deal. So it's a really good best practice to make sure that if there are costs incurred after you issue the cost certification, that you go back to that Excel funding requisition and you update that through the cost cert, and then put a column for after if you have invoices that come in after the cost cert. If you don't do that, you really won't know how your deal ended. So important to sort of backtrack, because somebody will ask you that a year or two later, and you won't know that off the top of your head because you're in the middle of another deal. So just taking the time to kind of go back and document is pretty important. It's a pretty important thing. At least I've found that over the 15 years or so that I've been doing this. So, so the first point sort of speaks to that. The budget line items in your GL and on the funding requisition should agree with the cost cert categories. When you're doing the cost cert, they absolutely should tie. What I've said is after the cost cert gets issued, it's very possible to have other invoices come in and you ought to go back and update that requisition, okay? The whole point here is to make sure that you get every dollar of subsidy from the tax credits that you've earned, right? That you've earned based upon eligible costs. So it's really important to reconcile. So the funding requisition really ought to be part of your perm docs. So we talked about the general ledger might not agree. There may be certain costs like the cost of cost certification that can't be included as an eligible cost, even if that can be included rather as an eligible cost. So that's something we typically see, that we don't get the bill from the auditors, but we know what the audit's going to cost. And so we're allowed to include it in the cost certification as a valid cost, even though we don't actually pay for that until sometime down the road. I think that's the only thing I can think of that is eligible, even though it hasn't been yet paid. So you will have some reconciling differences, but take the time to understand them. And then I'm sort of a big proponent of making sure that you have some say about what's in the cost cert. You know, I think I had spoken about this a couple of sessions ago, that some of the costs, and you're going to see this in the class exercise, are split across multiple categories, some of which, like legal, can be split across acquisition and development, and you could have legal costs related to the bond issuance. Not all of those legal fees are eligible basis. And your auditors get paid to audit. They don't get paid to do all that analysis for you. And while some will do it, they don't have the same attention time as you would have. And I know you might argue, well, I don't have a lot of time either. But at the end of the day, it's your agency that wants the credit. So if you can sharpen your pencil and take the time to parse things out, and your auditor can guide you and direct you as to what costs and how you might approach that. But if you take the time, I've found that I've been able to increase the credits that we're getting, because I've spent the time to really get the backup together and show the auditor that, yes, in fact, here's how it's allocated. So it's hard for them to do that without being really in the weeds, and generally their fee doesn't incorporate that. So here's our third polling question. What is true in terms of best practices for cost certs? So would we use different categories? Should we let our auditors control the cost cert process? Or should we make sure that the final funding requisition agrees with the cost cert when we issue the cost cert?
Gail, one thing I'll mention while we're waiting for the poll results to come in is I've had experiences of doing cost certs on acquisition rehab deals, and the client may give you the development cost summary from the development department's records, and you do your cost cert based on that. And then it turns out that operations also had some repairs and maintenance costs that were somehow omitted from the development. They just never thought about that being part of the rehab cost, but actually it is eligible, because it doesn't matter, you know, whether it's incurred by operations or incurred by development sources. The fact is, if it's rehab repair type stuff that's going on during your rehab period, it should all be eligible. But sometimes that gets missed.
So there were a couple things in the chat about 8609's, how we get IRS acknowledgement of the receipt. I think that they do actually acknowledge when you file the 8609's, you are required to file them. I do think we get an acknowledgement saying that they've received the 8609's for the project, so you should have that. The question is whether it comes to you or not. It might be somebody else in your agency. And then Karen also spoke about remaining developer fees. So yes, sometimes the developer fee comes in at the very end, and it's interesting. The savvy investors have taken to making sure the last bit of your investment money comes in after the 8609's are issued. So they are not going to give you all your development fee until they know you filed those forms with the IRS and that they have copies of them. And that's what would be the final milestone to get your fee. So it's really, really important for lots of reasons. So thank you for those points, guys. I appreciate that. So I think we're sharing here, and I think C is probably the best answer here, that the final funding requisition should agree with the cost cert at the time that cost cert is issued. Generally speaking, we try to make sure that the ledger categories are the same as what is used in the cost cert. We try to, it doesn't always quite match up, which is another reason you want to make sure your funding requisition reconciles to the cost cert, but hopefully they're the same. So C is probably the best answer, but I can see where the first answer would be appropriate under some circumstances as well. Okay, so we're gonna close out. Okay, so this is a kind of a class exercise. You should have a blank form in your handout, and you have the funders requisition that we gave you. What you're going to do is just take a few line items from the funders requisition, not all of them. And you're going to look at how much that line item is on the funders requisition, and then see if you can allocate it to the proper category as to whether it's eligible basis or if it's not eligible or if it's an amortized cost. Some of them will go on in one box. Some of them will be split across the categories, and we'll be reviewing that after the fact. So Scott, do you want to maybe put up the blank worksheet just so people know what they're looking for? And then we can put up the funders requisition after.
All right.
So you should have a blank form that looks like a grid.
Here it comes. Got it.
Okay, thanks.
Share my screen again now.
All right, so if you don't have this handy in front of you, you can just jot down what we're looking for. So these are the categories on the cost certification across the top. So and then down the side are the types of costs we're talking about. So if you look at the funders requisition, you'll see how much the acquisition cost us. So you should be able to see that a portion of that was land and a portion of that was building. So you would fill that in, those portions in on this blank format, this blank template, and so forth. Does anybody have any questions, or should we leave you to it for a little bit? All right. So Scott, why don't you, when you get a few minutes, we'll pull up the funders requisition.
All right.
Just make sure everybody knows what they're looking at. So Karen, modules 7 through 12, they're not yet available. We expect to make modules 7 and 8 and probably 9 available beginning of next week. It may be Friday. It may be Friday. If not Friday, it'd be Monday.
Okay, I located the sample funders requisition from last week's materials. It was in module 5. It took me a while to get to that. So this is the sample that you're using to solve this week's assignment.
Does everybody have that? I mean, you know, we're gonna be on a break, and then we're gonna come back and we're gonna review the answers. So, you know, if you don't finish, it's fine. You'll be able to take a look at how it all comes together. When you see the cost there, you'll see how it ties to this funders requisition. So we'll give you about 8 more minutes to kind of work on this, and then I think we're ready for our break, Scott.
Yeah, that sounds right.
Okay. Is this making sense to everyone? If you're new to this, if you haven't seen this before, it might take you a little while. And that's okay. That's what we're here for. And you know, you're not necessarily going to know the split. If it's okay enough to just say, I think this might be split, I just don't know how much in each category, that's fine too. You know, the person who's going to know that is going to be the person responsible with the auditor to prepare this. So somebody in your agency, whether that's the CFO or the controller or somebody on the development side, they should know the answers. So if you are finished and you want to start your break now, you can. We need to be back at 2 o'clock, or so on the hour, I guess, as Scott says. I'm not sure what time it is where you are. On the hour, if you could be back on the hour, and our next poll question would be happening at that point. So if you're trying to go for CP, please be back by the top of the hour. Somebody had asked about the link to all of the modules. I think in the very beginning of the chat, Sophie had shared a link if you're interested in getting back to the modules. Okay, thanks, Elaine. She's saying the presentation slides for module 5. So, and I think you would, Yeah, I know you had said 5, so we'll make sure that we get that corrected. Thank you very much, Elaine. So this is, Scott and I have been teaching for quite a number of years together, and this is our first virtual teaching session. So it's interesting, you know, we're happy to have you bear with us as we go through this in this format for the very first time. We appreciate all the comments and suggestions that you have. Okay, we got a couple more minutes till we're at the top of the hour. So hopefully people will be finished enough and come back from break. Mhm. Hmm. Might be easier to just see the whole thing. Okay. I think folks should be back from break. We might need the polling question. So again, it's just a soft question. Make sure everybody's back. Okay, I'm always happy to see that people, there's nobody who says, no, I haven't learned a single thing. All right, well, most of you are learning something new. That's great. I think if you were to look at the folks who are attending, it's a wide variety of folks. We actually have people who are brand new to the industry, who just started within the past few months. And we have folks who have been around for a while, some CFOs who are new to the industry, some CFOs who have been doing this for a while. So we do expect to see a variety of responses on this particular question, but thanks for sharing. So if you look at the answer key that Scott's provided, I think the first line should be pretty self-explanatory. If you look at your funders requisition, you'll see 3.25 million in land acquisition cost and 11,650 for the building shell itself. And when you add those together, you get to the total acquisition price. So architecture, that typically belongs right in the construction cost line. It's not part of your land. It's not part of the building shell. We don't amortize architecture costs, and they are includable in the basis. So all of the architecture fees are included in this category of rehab construction costs. Audit and tax fees, those are not part of basis. They are amortized, so they're capitalized and amortized over some period of time. Sometimes the cost cert is amortized. Scott, maybe I've seen that amortized and I've seen it expensed in full in the year that it's performed.
Yeah,
So
I see it expensed more often, but
You do.
before the break, you mentioned that it could actually be part of eligible basis, and that I've seen that too, where they said that cost certification is actually part of the cost of construction. But like you pointed out, it's usually done after the fact, and theoretically, it maybe is harder to make that hold that treatment. So anyway, expensing the cost cert is where I usually see it.
Yeah, I think that's a good point in terms of state by state. Scott and I were talking before we started today about, it's so interesting each state agency sees things in a different way. And our state agency sees things one way in one year and another way the next year. And so you kind of don't know until you submit the cost certification to them. Once the cost certification draft is submitted to the state agency, they have the right to review that and ask you to reclassify things if they so deem that you should. And we have been successful in a lively discussion, having them change their minds, and sometimes we're not. So I think in this case, they were attributing the audit fees pertaining to the cost cert as pertaining to the credits themselves and not the construction of the building, and which is why they decided it should be expensed. But again, that's a state by state decision, and it could be a year by year decision. Construction loan interest, of the total construction loan interest, you'll see that 384 is part of our construction cost. And that's how much construction interest was paid before the placed in service date. If you had construction loan that continued on, which many of us do, you might see construction interest actually expensed after the placed in service date. So you would normally, I would say probably more normally, see this lapse over. The only time it doesn't, so normally you might see this in both categories. In this particular case, you see it just in the rehab. Development fee, so that's really interesting. I don't know how many of you have seen this. You can see that it's spread over both acquisition and rehab. And so that was our state agency saying that we should attribute some portion of the fee based upon the value of the cost in each category. I don't know that I agree with them. I think the acquisition of the land and building takes a fairly small amount of our development staff's time, and there's substantially more time spent on the permitting phases and pre-development phases and then the construction period. So again, if you were going to allocate anything, I would err on I would probably allocate less, because I just don't see it as a major function of our development staff. It's usually more the attorneys. Hence the allocation of legal to acquisition, because it's typically attorneys. So there you see our legal fees spread across acquisition, across rehab, and then amortized and expensed. Some of the legal fees are amortized or expensed, and some are non-deductible. So that's the category that's usually the stickiest. So if you take a look, you'll see that. And then somebody's pointing out syndication fees. Let me just take a look. I think in the chart we have 36,000. So let me just look at, I'm looking at the funding requisition. All right, I'll have to take a look for that. I don't see it right off the top of the final funders record. Oh, this is a prelim. That's why I need to pull up the final. Let me just give me 1 second. Yep, so syndication costs, you're right, it's 91,250. So I'll correct that. Thank you for that. Trying to see where I might have picked that up. Oh, you know what, that I think it's the description. 36,532 are the fees that we paid to the state credit agency. They're LIHTC fees. If you look at your funder requisition, you'll see it on row 29. It's low income housing tax credit fees. That's the fee that we pay to the credit agency for the work, the fine work that they do to allocate us the tax credits. And so that number correlates. So I will probably change the description on that line item. Those are low income housing tax credit fees. So thanks for catching that. I appreciate that. So I think, Scott, if you want to pick up with the cost cert itself. So Scott's going to talk to you a bit about not just the numbers. You'll see these numbers when we go to the cost cert, but not just the numbers, but the other types of things that you're going to see in a cost cert. He's got some additional information for you. So he's just going to pull that up and continue.
So in our course materials, we have most of a cost cert after that exercise page. And it begins with the page that at the bottom says, what is it, 2 of 14. So page 2 of 14. So apparently when the cost cert was issued, page 1, I'm guessing was the auditor's report. Normally that would be the first part of the cost certification is the auditor's report. And it looks a lot like an auditor's report on a financial statement, except that it's referring to this cost cert. It says we've audited the cost cert and that the costs are appropriately reflected, based on tax law. It's not a GAAP presentation, it's a tax thing. So it might refer to section 42 of the Internal Revenue Code in the opinion paragraph of the cost cert. We're basically saying that the eligible basis is calculated correctly in conformity with section 42 of the Internal Revenue Code. So that's where it differs from a standard audit report on a financial statement, because we're not talking about a GAAP presentation here. Anyway, we don't see the opinion page because that's really the auditor's job to prepare. But we start with page 2, which is the kind of the spread of all of the actual costs. So the exercise that you just went through was a small version of what the auditors and the client does when they prepare this table of spreading every line item on the cost cert, which, like Gail said, would tie to your requisition line items. So all of your sources are down the left-hand side of the page there, and then it's being spread into the appropriate bucket across the top, whether it's land, building, shell, rehab costs, amortized, or non-deductible. So this sample kind of gives you a snapshot of where those costs typically get categorized. And it should be kind of similar to what was seen weeks ago when we looked at the projections, because you'll recall a similar effort was done before anything was even started construction-wise, where all of these same cost categories were spread in one of the pages of the projections into these different buckets. So the idea here is that when you entice the investor to come into the deal at the beginning, you're telling them this is what we're planning on doing, and you're showing them a schedule like this in the projections form without any audit opinion because it hasn't happened yet. And then after the construction is done, the auditor has to express an opinion that these costs reflect the actual costs and the categories are appropriate to categorize those costs into. So it should be kind of similar to the original, but not exactly the same, because actual costs never equal budgeted costs. So the auditor, when you start the audit process on these cost certs, really the auditor's objective is to find source documents that support each one of these line items. So the land and the building might be supported by things like a purchase agreement for purchasing the land and the building. There might be an appraisal that shows how much goes to the land and how much goes to the building. So documents like that. And then the other categories, the big one is usually the construction contract itself, which usually would be supported by a general contractor's bill. And that might be spread onto multiple line items we've talked about before, because there might be site improvements as well as general contract costs, and maybe the overhead needs to be split out, and the construction bond needs to be split out, and the furnishings need to be split out. But all of those types of costs are supported by the general contractor's bill. A lot of these other ones, architects, engineers, et cetera, are supported by either contracts or billings from those vendors. The title costs are supported by escrow statements from various loan closings and purchase escrows. Construction loan interest, you probably have monthly billings from your construction lender that show how much the construction loan was costing each month. And development consulting, bond fees, all of these things will have supporting documents, and the auditors will be asking to see a variety of those as part of the audit process, so that they can eventually turn around and say, yes, these are the real costs, and yes, they are categorized appropriately. So that's the most important page of the cost cert. And the spread on the line items that we saw in the exercise mirrors the spread that you'll see here. There's just more line items here because the exercise only asked for about 6 line items as opposed to about 30 different line items here. Some of those non-deductible items are the reserves. You see towards the bottom, the replacement reserve, the operating reserve. Not land, not building, not expense, not amortized. It's just cash sitting in a reserve account. So that's not even a deductible item until it's spent on something. This format shows these sources not in the table that I was describing earlier, the way we see it in California, where this is a matrix that has the sources across the top and the uses down the side. But instead in Massachusetts, the sources are all just listed at the end. So you wouldn't, from this page, you wouldn't necessarily know which source paid for which use. The California version of the cost cert answers that question by putting it into a matrix format. So you can see which dollars came from which sources and they were used for which uses. But luckily, the good news is the sources equal the uses. So that's what you have to, this way, really the purpose, one of the purposes of the cost cert is to prove to the awarding agency, the state tax credit awarding agency, that investor equity was needed, in this case, 11,850,000. This proves without a doubt that this project could not have been built without that 11,850,000 in investor financing and capital contributions to the partnership. So that reassures the state agency that the tax credits, which are often quite competitive, and we talked earlier about how they're awarded based on points and meeting this qualified allocation plan criteria. Well, the state wants to make sure that after everything is said and done and projects built and up and running, that you really did need that investor capital and you really did need those tax credits in order to get that capital. So this little table proves to the state that every dollar of investor capital was actually needed to fund this building, because otherwise you would have had more development uses than you had sources, which means you would have not been able to pay the last cost of development because it didn't balance out. So that's a big purpose of the cost cert as well, is to make that point. Let's see what else is on here. So we have the credit calculation on the next page. We've seen this before in earlier modules, but here again, we're taking the acquisition total and the rehabilitation cost total and making certain adjustments to that. In this case, no commercial space, so that's blank. But if there was like a ground floor commercial, we'd be backing out the costs that are allocated to that ground floor commercial, which is usually done based on a percentage, just like a square foot percentage, or could be actual costs if you know exactly how much that commercial those commercial costs were, they would be based on actual costs. But often it's an allocation of the entire building cost based on square footage in the absence of any more specific information. So in this case, we didn't have any commercial, so that's blank. There was a historic rehab credit we saw in an earlier module. So I mentioned at the time that, you know, the low-income housing tax credits doesn't allow you to take eligible basis to get credits on the same dollars that you've already claimed historic tax credits on. So if you have historic tax credits, in this case, 2.8 million of historic tax credits, you can't use those costs again to get more credits, because that would be getting $2 of credit for just $1 of cost. So you have to back that out. So we see 2.8 coming out of the rehab portion. This doesn't affect acquisition, it's only rehab where these historic credits get reduced. And that doesn't come up on most deals. You'd have to have historic structure, has to be a certified historic structure in your community that needs to be maintained, usually like a facade of an old building that can't be maintained. And so you're getting a credit for rehabilitating the interior of the building to make it useful while maintaining the historic nature of the exterior facade. That's often what's happening. So it comes down to eligible basis. As we saw before, we get 100% of the acquisition credit, but we get 130%. So it's a 30% boost because this was a hard to develop area. We mentioned before that would mean it was either in a qualified census tract or what they call difficult to develop area. Often big cities the land is just so expensive that these are considered difficult to develop areas, and you get a 30% boost to entice you to make the effort to go ahead and do a development, even though it's difficult.
Right.
So that came up to 11.8 million acquisition, 16.1 on the rehab. And then this low income percentage, 90% in this case. So that tells us that it's not 100% affordable. And we'll see on a couple of other, in a few pages, we'll see a breakdown of which units or which buildings have some market rate units. But apparently this project does have, it was actually about 7 out of about 85 units were market rate. And so you don't get any credit on the market rate units, either for acquisition or rehab. But in this case, the rest of the units amounted to 90%, and we'll see how that number, where that number comes from later on, was the affordable units. So we multiply 90% times both of these numbers to come up with the qualified basis. And the final step to calculate the credit is to use the credit percentage. We said weeks ago that now it's fixed at 4%, but back in the few years ago when this project was developed, it was floating, and they had a choice of either locking in the credit at the beginning or letting it float and using whatever the monthly amount was that was published in the month that the project was finally completed and placed in service. So whichever one they did, in this case, it turned out to be 3.21%. Nowadays it would be 4%, but back then it was a floating number and it was 3.21. So that produces this annual credit of 342,000 acquisition and 469 rehab. And so that's a annual credit that they'll get every year for 10 years. So this calculates that amount. So behind that, we have a schedule that breaks down the calculation that we were seeing before, building by building. So it's actually based on BIN numbers, building identification numbers, which every building will have. And because buildings have different addresses, you know, in this case, you'll see each building with a unique address. Each one might have a different place in service date. So this has to do with when the final unit for that building was placed in service. The entire building was placed in service when the last unit in the building was placed in service. So in this case, all of the buildings were placed in service on December 11th, 2015. But this is where you see the unit fraction we were talking about earlier. So there are 81 total units, but only 74 are affordable units. So that means we have 7 market rate units. And on a building by building basis, we have to determine using the lower of the square footage or the unit count, what is the percentage of low-income housing percentage that we're able to use. So the reason they say it's the lower of unit count or square footage count is so you can't manipulate, you know, assuming that you wanted to give the market rate units huge space to entice people to pay high rents and then force the low income units to be very tiny, that this lesser of unit count or square footage count will make you pay the price for that, because then the low income units would have a smaller square footage, and overall you'd end up with a lower result than if you were able to use unit count, ignoring square footage. So you have to do it both ways to make it fair. So building by building, there's a calculation here of the low income housing square footage compared to the total square footage. In some buildings, it's the same because we have 5 low income units and 5 total units. But in other buildings, if you look down, find one that's different. For example, 51 Fernwood Road has 4 low income units, but 5 total units. So that's a ratio of 4 to 5, which is 80%. But square footage wise, the ratio is 68%. So apparently the tendency in that building is the low income units tend to be a little bit smaller than the market rate unit, apparently, because it produces a lower percentage, 68%. square footage wise. So looking at the lower of either 80% or 68%, the lower, of course, 68%. So multiply 68% times the acquisition basis, and you get the qualified basis for that building of, instead of 697, it's 475. So that's the 68% of 697. Anyway, it's a very detailed calculation, building by building, that shows the acquisition credit for each one of these buildings. And overall, it comes down to that total qualified basis, that same number that tied to the acquisition schedule we saw on the previous slide. 10,672,000 is that same 10,672,000 we see there. So then the next page does the exact same thing, but for the rehab cost, same idea, except notice that the placed in service date is a little bit later, because the acquisition date was at one point, but the rehab was, undertaken from the time of acquisition up through January 1st, when the rehab was completed. So we have placed in service dates of January 1, 2016 for every building. So all of the rehabs for all the buildings were deemed to be completed on January 1st, 2016. Then the rest of the schedule is the same as the previous one, where you're comparing market rate units and low income units, square footage and unit counts, and coming up with the same percentages we saw before, but allocating it times the rehab basis now. The rehab basis is the 15 million minus the historic tax credit we saw. So we get the 130% boost. And so eventually we come to the numbers that we saw again on that earlier page, which was a summary of the rehab credits. So then there is a schedule here that shows some additional information. This is, again, something that's kind of unique to Massachusetts. Amounts paid to receive or received to date, amounts yet to be paid in the future. So it's kind of showing timing wise what's already been paid versus how much is going to be paid in the future, so that people know what's going to happen with future capital contributions, when developer fees are going to get paid out in the future, et cetera. Some descriptions here in terms of little subnotes talking about each installment and when developer fees will be paid. Another schedule of uses of the developer fee, how much is going to be paid from development sources versus how much of it is going to be deferred and paid out of operating cash flow. So we talked about deferred developer fees. So if you're if you don't have enough development sources to pay for the entire developer fee, a portion of it needs to be deferred and paid out of future cash flow. And that's what this schedule is showing. And we'll talk more about that as we get into the operations aspect of the boot camp. And you'll start to see how these cash flow from operation calculations work, and how it is determined how much of operating cash flow is going to go to pay this developer fee. But at least in the projections we saw weeks ago, that in some cases it could take many years to pay off developer fee. And we made the point that you do want to make sure that it gets paid long before year 15, because the investor wants to make sure they don't want to claim credits on something that wasn't ultimately payable. Then, following all of those schedules, we have notes to the cost certification, similar to notes to a financial statement, talking about the organization, accounting policies. Notes are optional on this kind of a presentation because it's a non-GAAP presentation. It's a tax basis, but usually there'll be some type of note, in this case, talking about all of the financing, construction loan terms, permanent loan terms.
So I actually really like having the notes, because there's a lot of information in here that you'll forget about 5 years from now. Yeah. So it's really a helpful data capture. But as Scott said, I don't know what states use this format or don't. I just know Massachusetts does, and Scott knows that California doesn't. So I'm not really sure what your states do, but I do find it really helpful.
Yeah, we typically would see all these same notes in the first year audit, financial statement audit, not necessarily in the cost certification. But anyway, you have to do what your state requires. So the notes look very familiar in terms of, first year financial statement and subsequent years as well, for that matter.
Right.
So that's basically the entire cost certification. That's the last page of the cost certification. There was 12 of 14. So we don't see 13 of 14 and 14 of 14. Let's see it. Oh, we do, because those are the 8609s. And that's going to be discussed in a few minutes. So we'll stop here at page 12 of 14. And let's see, are we ready for poll? I think we are. Poll 5. Sophie, let's launch poll 5. So what this question is asking is, does each cost category really neatly fit into, does each cost neatly fit into one category? Or is there some overlap? And most of you are saying, yeah, there's probably an overlap. I think that's the official answer is yes, there is probably some overlap where costs we were seeing in the exercise where costs are getting spread into multiple categories, land and building, for example. Legal was the most common example of this, where it's actually being spread between perhaps some of legal is land acquisition legal, some legal might be construction loan related legal that goes into the building rehab category. Some of the legal might be permanent loan related legal costs, which goes into a amortizable category of permanent loan costs. And some of it might be syndication related legal, which goes into a non-deductible syndication cost category. And there may be other types of legal expenses too, ground lease related legal. Yeah, that legal line item might be spread into every single category that you have on the cost certification. So they don't all fit neatly in one category typically. All right. So let me get back to my slideshow. PowerPoint, I should say. All right, so the next topic we're going to be talking about is the 8609, which I'm going to show you after I show this slide. But you saw it briefly a minute ago when I flashed it. It was page 13 and 14 in the cost cert that we were just looking at. So Gail mentioned that the Form 8609 is a tax. It's an IRS form. It's a nationwide form. They're not going to be different in different states. It's a one form for every state because it's the same IRS form. It's not a state form, although it is submitted to your state awarding agency. So the process is to prepare an 8609 for each building. So each building will have its own form, and there could be two for each building, one for the acquisition and one for the rehab. So remember that schedule we just looked at, which had about 20 buildings for acquisition and about 20 buildings on the rehab page. So imagine there's going to be one 8609 form for each one of those 40 buildings between the acquisition and the rehab costs. So you got a lot of 8609s to attach to your partnership return, in that case, about 40 of them. And it has to be attached every year for the entire 10 years that you're claiming the credits. So generally the 8609s are drafted by the CPA firm, tax preparer, and sent to the state agency, you typically will send in the 8609 forms as well as the cost certification and maybe a placed in service package that indicates maybe each of the units, when they were occupied, income level of the renter for each unit, because you probably, maybe in order to get additional points in the allocation, you had to promise that some units were going to be targeted at 60%, some would be targeted at 50%, some at 30%, whatever these targets are. You have to identify on your place in service schedule, typically, which units are meeting which income levels. And that way you're showing your state awarding agency that you've rented it up in conformity with the promises you made at the original outset of construction. And now the costs have been certified, the renters are in there, and here's the 8609 form. Very easy for them just to look at all of this stuff and sign off. But the fact is, like I said, it may take them 6 months to do that, or even longer, because you're not the only tax credit deal in your state. And so there is quite a backlog on approving these documents. And unfortunately, sometimes questions will come back, and maybe the costs that were actually incurred differ to some extent from what the state was thinking would happen. And in some cases, that difference is enough to cause concern to the point of asking questions. So be aware that the state agency may be coming back to you, pushing back on some of these items. Gail mentioned, it's probably a learning process where you find out when you submit it that, oh, the state has changed their interpretation of how this particular cost is supposed to be treated in my state this year, unlike last year. So now they want it moved over here. And so then we have to reissue the cost cert. This doesn't happen very often, but it could happen. And or maybe another scenario is land is a big one, where in California here, the state agency knows what the land cost is up front because you put that in writing when you apply for the credits in the first place. If later on the cost cert, more land was incurred, because I had one situation where the parking lot wasn't big enough and they had to acquire a parcel next door to increase the land size so that they could build more parking spaces for their tenants. So that increased the land basis. Well, when the cost cert went to the state showing more land than the state was expecting to see, the state said, no, you can't change the land cost. You already told us what it was going to be before you started the construction. It's too late to change that number. Well, for GAP, we have to change the land cost because they spent more money on the land, but on the cost cert, they didn't want to see that land show up because that wasn't part of the original plan. So that was kind of a situation where, you have to revise it just to get the state to approve the final 8609s.
So
even though the land had nothing to do with the eligible basis anyway.
One, I think takeaway for me, having learned this the hard way, letting the auditors issue final the cost cert, only have to go back to reissue again when the tax credit agency decided differently, is just don't issue final, just issue a draft cost cert and send it to the state agency, and then deal with whenever they come back, if they've got changes, make the changes, and before you issue it final, because I think it's just a lot of wasted time for the audit folks. And if it's during busy season, it's painful, if they have to go back and reissue something they've already issued. So I think I learned that the hard way myself, that it just makes a lot more sense to hold on to the cost cert in draft form until everybody's signed off on it.
Mm-hmm. And so the auditor will issue a draft tentative and preliminary copy, and it'll be stamped accordingly. And that you could see if your state agency will accept that, or if they want to see, or if they'd rather have it called an interim cost cert. And then there's a further iteration of the interim when other changes come in, and all of this leading up ultimately to a final version. So different states have different preferences on whether it has to be signed by the auditor or it can be a draft or et cetera. Anyway, the final bullet point here on this slide is this 8609 process is typically one of the last milestones to achieve in order to receive your final equity installment from the investor, because usually there's a little piece of the developer fee, maybe the last 25% or so, being held back until 8609s are received, which is the final step in the development process, where the investor says, okay, now you, the developer, have done everything that we expected you to do, and we can release the final chunk of your developer fee.
Sometimes we even see maybe 5% of the fee hung out until the first year return gets filed. I've seen that happen as well. So from a if you're in the finance department, you need to care about cash flow, right? So it's important for you to know what the milestones are in order for you to get your development fee. And it's important for you to play a part in that. It depends on when you budgeted that fee to come in for your organization as to when you need that to make payroll or pay for other costs. So you need to understand what those milestones are and be part of the plan. If things start to slip, be part of the plan to pull them back on track quickly so that you can get your fee on time.
All right, so now let me reshare my PDF file here so I can show you those 8609s again.
Yeah, I've only given you 2 of them. I didn't give you all 40.
Thank you. All right, hold on here. There it is. Couldn't find my PDF in my share screen. There we go. All right, so hopefully you're all seeing the 8609s now. This one, so the top of the form, I'm having trouble centering on just the top, but anyway, you saw name and address, name of partnership, ID number, etc. But anyway, on line 1A here, you see date of allocation is blank, maximum housing credit dollar amount allowable 21,000. So I think these numbers are coming from the original application. The maximum credit percentage, 3.21, is the number we saw before. Maximum qualified basis, 655. This is just for one building, so keep in mind this is only 1 out of 40 buildings, the basis for that one building. This is the acquisition 8609, so it's showing the 100% rather than 130%. And then it shows the percentage of aggregate basis financed by tax-exempt bonds. So a few weeks ago, we talked about the 50% test, and we said that if this number is not more than 50%, that means that the project was not primarily funded with tax-exempt bonds, and that would be bad. So you always want to make sure it's more than 50%. In this case, it was 51.79%, so it just barely made it over the hurdle. But that, what it means is that you can then claim credits, 4% credits, in this case 3.2% credits, on the entire rehab cost, not just the portion that was financed with the tax-exempt bonds. If this number dropped below 50%, then you would have to only take credits on the dollars that were actually paid with tax-exempt bond financing, and you wouldn't get any credits on the dollars that were paid with investor capital or other firm loan sources. So it's a very important thing, and you want to make sure that each building passes the 50% test building by building. So you're allocating costs among the buildings as well as allocating bond proceeds among the buildings to make sure that every building is passing the test.
If you are in a situation where you think this is at risk, trust me, everybody's watching this. Everybody, the investors watching this, your CPA firms watching this. I've seen it happen once where we had to literally forego development fee to get that 50% number to be high enough. But everybody watches this. So the other repercussion is if you can't satisfy this test, and I actually have not heard anecdotally from anybody that they failed this, but because everybody's watching, but it means that what were tax exempt bonds, meaning the interest is tax exempt, would now become taxable. So the investor has a keen eye on this to make sure that they don't end up with bonds that are taxable and they're paying taxes, which after all, this whole thing is geared towards reducing their taxes. So it's a really important number for lots of folks to see. And Scott, have you ever seen it fail?
Well, I've seen it come close to failing. Typically what happens, I might have mentioned this in a previous week, but the most common reason for that is, like I was saying earlier, if everything's rushing for this December 31st lease up to the point where some of the construction costs were also incurred in December and the final COs happened like late December and the contractor's bill arrives in January of the next year, and then you draw down your bond proceeds in January, well, that's too late, because if you wanted to take credits in the year that you had the December rush, which is why you were rushing in the first place, you're not allowed to count bond draws that occur in January of the following year in this 50% test. So when you get that close to year end and you haven't drawn down all of your bond proceeds yet, that's a very dangerous scenario. And it most often happens either because the final billings arrived in December and you didn't get around to drawing it, or sometimes there's even some site improvements or some additional non-residential related construction work that's going to happen the next year. Maybe you're not even worrying about claiming credits on those dollars, but if you're planning on funding them with bond draws, you were planning on using the bond proceeds for this 50% test, and now it's too late because you didn't draw the bonds down in time. So that's the biggest risk, I think, is waiting until after year end to draw down your bond proceeds, and then you fail the test because you don't have enough bond money to get over that 50% hurdle. All right, so the bottom part of this form involves signatures and a few check the box things. There's the eligible basis number that we've seen before for that building. And then there are some questions. Is this building part of a multiple building project? Yes, we saw there's about 20 buildings. Then there's an election. There's some elections here. Are you electing to begin the credit period the first year after the building is placed in service? No. In this case, we're electing to take the credits in the year that it is placed in service. And it's a 40-60%. In the first couple of weeks, we talked about the 20-50. 20% of the units are rented to families at or below 50% of area median income, or in this case, the option was 40% of at least 40% of the units are rented to families at or below 60% of area median income. So you have to pick one or the other of these two methods. So that was the acquisition credit. And then this is the same 8609 form, but this one's for the rehab portion of that particular building. So now we do see the only difference here is we see the 130% basis boost there. And the rest of the form is, I think, identical to the one we saw before. So you're really waiting for these 8609s to come back in the mail from your state agency. And it may be a long wait, unfortunately, but once you get them, you want to make sure that everybody knows. So let your CPAs know that they've arrived, because they're going to need to be attaching these to the tax returns each year. And you'll need to communicate with the investor somehow that that's happened so that they can release the final investor capital contribution so that you can pay your developer fee, the final installment.
Yeah, they actually usually like to have you send them the 8609s so that they have them. Oh, that's very funny. Somebody used to supervise Kate Racer. Wow, good for you. She's been there quite a while. She's quite a force to be reckoned with. So I'm sure you enjoyed working with her. But usually our investors actually ask us to scan the 8609s and send them to them. They really want to have them on file themselves. They don't normally want to just take our word for it. So you should be prepared for that.
All right. So I
think-
guess we're ready for poll number 6.
Yeah. So what's the primary purpose for the forms 8609? How many credits were received for each building to let the IRS know how many tax credits were awarded to the investor, or both?
So A and B is the correct answer. It really has multiple purposes. So it calculates the credits for each building. Yes. It also lets the IRS know because, up until now, I didn't, until you file your first tax return, the IRS doesn't really know anything about your 8609s or how many credits you're getting. It was the state agency that was generating this form or approving the form. You drafted it, they signed off on it, send it back to you. All of this happens without the IRS's knowledge, really. It's all happening at the state level. But once you start filing your annual partnership tax return, then you would be attaching these 8609s and claiming the credits and reporting it on the K1 that goes to the investor. And like I said, in that first year, you may be still waiting for the 8609 to be received when the deadline for filing the return has already come. And so you have to file without the 8609, claim no credits in the first year, and then do some type of amended return subsequently when the 8609 comes in, which may no longer allow you to change that first year under the new amended return rules. But there's also a hardship approach that we've seen used more and more, where you can make a claim that it would be a hardship to the partnership not to claim the credits in year 1. And so even though you don't have the 8609s, you might include a draft copy of the 8609 that's unapproved and claim the credits and just appeal to the IRS under this hardship provision, saying that you're going to claim the credits anyway, even though you don't have the 8609. So that's a new approach that I've seen used these days, because it's taking so long to get the approved forms back. It's just creating too much havoc. And now that the amended returns don't really change the prior year, they only flow through the current year, that's making things even more confusing than they already are. So keep that in mind. Ask your CPAs if the hardship approach would work if you're in that situation.
So remember why your investor cares. Like, what difference does it make to them if they take the credits a year later than they were going to? It makes a huge difference. So think about the net present value of the return on this investment. If it starts a year later, it's going to change the return that they're projecting. And so they care very much, although you can ask. I mean, I've had investors answer differently when I've asked, does it matter to you? Some might say, no, it doesn't matter, and that's okay. So again, having a good relationship with your investor to work through these issues in your very first year is really important.
All right, let's see if I can advance my screen now. There we are. So we've reached the end of the PowerPoint, but we do have a few minutes left. And because this is really the end of the whole development cycle, which is really the first half of the boot camp, we'd like to open it up to questions, not only for today's materials on cost certifications and 8609s, but really anything that we've covered during the last 6 weeks to do with pre-development or development. This would be a great time to kind of draw a bow around the whole development cost accounting process by asking, either using chat or unmute yourself. And feel free to raise questions now. We do have about 8 minutes left before the hour. Otherwise, next week, we'll be getting a new module talking about operations. And actually for the next 5 modules until week 11, it'll all be more operational issues. So we're going to be leaving development behind. Some of you may be relieved to hear, and moving into the operational part of the course.
Scott, maybe you'd like to talk about our new presenter, Rita.
Yeah, and I'm going to be handing off my share of the presentation duties to Rita De La Cruz, another partner in our firm, Linguist Funnies and Joyce here in San Francisco. Rita's been auditing operational as well as development financial statements and cost certifications for the last 20 years with our firm. And Rita will be a good speaker for you. So this will be the last time you'll see me talking to you. So anyway, if you do have questions for Gail or I, and Gail will be continuing for the rest of the 11 weeks. I'm the only one handing it off. So anyway, do feel free to ask questions now or later on. I think our contact information is here on the next slide. And Sophie, I think you can launch the evaluation poll as well. And once you've completed your evaluation, then you can sign off unless you have questions that you'd like to pose. Gail and I will hang around until the hour to answer those questions.
So Scott, thanks so very much on behalf of the Strength Matters team. We've so enjoyed having you. I've so enjoyed teaching with you. We've been at this quite a long time, and just really great to have you share your wisdom and your knowledge, having been so experienced in this field. So thank you very much for modules 1 through 6.
Thank you, Gail. Yeah, I think it turned out well, the transition from in-person learning to online learning. We were talking before we started that it's a little bit less rushed this way. When we had to do all this in 2 days, all 11 of these, they weren't modules then, they were just, sections of a 2-day presentation. I think now my experience is we have a little bit more time to delve deeper into each of the topics, because a frequent comment was it was too rushed, too much information to get in 2 days, too much to absorb. So I'm hoping that class also feels that it's better spread out in these smaller chunks. So I like the Zoom approach to this learning.
Have a great weekend, everyone.